So will we see a repeat of the roaring 20s? The RBA stays on message, and unless you've been living under a rock, you wouldn't know that the property market is hot. Welcome to the April Economic and RBA update. I'm looking forward to getting into it. There has been plenty of data and economic news over the past month, including the RBA announcement today. So let's get into it. I want to focus firstly on the world economy. So there's definitely been factors in which are driving growth. Three pillars really is what one would say in terms of these key factors. Number one has been the global monetary policy response. And this has obviously got everything to do with keeping interest rates low and stimulating the economy and keeping the bond yields under control. Number two has been the fiscal stimulus that have been announced by many countries to make sure that they were reducing the unemployment and keeping businesses open. And so there weren't any foreclosures of business, which has been critical to keeping the employment going. And then finally now is the vaccine rollout. So we'll definitely have a material impact in 2021 as we see economies being allowed to open up. So that's what we've seen sort of globally. Let's take a look at what we're hearing from the global commentators. So the OECD has upgraded the global forecast for this year to 5.6% for the year. Now that's up from a 4% reading, 4.2% reading that they forecast only in the December quarter. Now they're also forecasting a 4% increase in 2022, and this is up from 3.7% from those December forecasts. So that's positive. Also, the World Trade Organization has raised its projections for growth on the global economy for the year to 8%. So they believe global growth in trade will be plus 8% for this year. Now that's an increase that we haven't seen since 2010. And this obviously rebound marks the significant bounce since 2020 when the pandemic led to a global contraction of trade by negative 5.3%. Turning our attention to the COVID update. So we did see, according to the Financial Times, currently there are 7 different vaccines in circulation that are being administered around 179 different locations globally, and over 652 million doses have been administered. So that's positive as we head towards that herd immunity at that 70% critical mark that they're looking to achieve. Now let's go into obviously the biggest country in the world economically. Let's talk about United States of America. In March, we did see the US President Joe Biden signed his $1.9 trillion pandemic relief bill into law. This new bill includes provisions for $1,400 as a one-off payment to low and middle income households. So that's obviously about stimulating spending and getting the US economy going. We did see the GDP numbers come out for the third quarter in December. Were revised up marginally to 4.3% growth from 4.1% that was previously advised. The jobs data is incredibly positive. US jobs data last Friday showed the economy added 916,000 new jobs in March, thumping the expectations of around 660,000. The country's jobless rate fell 0.2% to be 6%, and the labour participation rate was added at 0.1% to 61.5%. So good story there on the job side. We did see also President Biden outline further stimulus. He has a $2.25 trillion infrastructure spending spree, which is in addition to the $1.9 trillion economic relief package. Now, this is a 4-part, 8-year plan to be paid primarily by corporate tax rate hikes to 28% from the current level of 21%. And they're also talking about a 21% minimum tax on global corporate earnings. Now, in terms of where the money's going to go, he's looking at spending $620 billion on transportation, $650 billion on initiatives tied to improving quality of life at home, $580 billion for strengthening manufacturing in the US. And obviously, again, there is also a proposal of a rollback of the tax cuts that were introduced by Donald Trump back in 2017. So that is his progress in terms of what he wants to get done for the US economy. It is obviously a proposal at this stage, and it is set for a very rough and challenging road through Congress to be passed into law. President Biden also announced a new goal of 200 million coronavirus vaccinations within his first 100 days in office. Earlier, he'd said 100 million vaccines by that time, but he reached that on his 59th day in administration. So that's also positive news there in terms of the rollout of the vaccines in the US. And on the back of this obviously positive health story is good economic news, which has seen the US share markets reaching record highs. So we did see the S&P 500 and the Dow both reaching all-time highs recently. So that is positive news for the US equity markets. Turning our attention to China. China is again in a very, very strong economic position. The outlook for the Chinese economy picked up in March with services purchasing index lifting to 56.3 from a previous 51.4 reading in February, marginally below the levels that we saw in November 2020, but it's close to the highest levels that we've seen since 2012. The manufacturing PMI index rose modestly to 50.6 in February from a 51.9 in March to 51.9 in March, I should say. So the combined PMIs point to a solid economic growth in China over the next 6 months. In terms of the large batch of data that we did see released from China during the month, there's some very, very strong numbers in here as well. So in terms of data from January and February, signals that China may record GDP growth between 15 to 20% for the March quarter. And this is on the back of the economy being semi-locked down this time last year. Taking a deeper look into those numbers, industrial production rose 35.1% in the first 2 months of the year compared to the same 2 months a year ago. And we also saw numbers expanding heavily, 33.8% in fixed investment expansion, 35.1% in property investment. So there is a lot going on in terms of activity there. However, behind what I call the China curtain, in regards to their socialist controlling policies, we did see President Xi signal a continued crackdown on internet platform companies. And according to the state's media, the regulators have been ordered to step up oversights on internet firms. And some analysts estimate that online sales account for about 50% of China's retail sales. So we did see retail sales expanding 33.8%. So that is also quite encouraging for China. In terms of the European markets, the CPI inflation remains muted in Europe, rising 0.2% in February, which is an annual rate of just 0.9. And now the annual pace of core inflation is significantly weak at 1.1%. The European Central Bank, the ECB, left key policy rates unchanged with the marginal lending facility at 0 and deposit facility at negative 0.5%, which was universally expected. So don't go putting money in there. You're going to be charged for it. You need to be, as banks, they need to be out there lending it. However, the ECB also continued its pledge to ramp up government debt purchases in coming months as their role plays out around keeping bond yields in check. And in terms of the economic forecast, the ECB upgraded its inflationary forecast for the year to 1.5% from 1%, but long-term expectations remain subdued. And GDP numbers out of Europe forecast for this year were lifted to 4% from 3.9%, but definitely lowered in 2022 as they start to come out of that recovery. So there's a little bit of work to do in Europe to get them back into an important growth phase. In terms of New Zealand, so some important information out of New Zealand, obviously a very, very small part of the global economy, but there was some interesting information around property. New Zealand introduced measures to cool the booming property market over there. Investors will no longer be allowed to claim interest payments as a tax deduction. Also, the period required to hold a property to avoid paying capital gains tax upon the sale of the property was lifted from 5 years to 10 years. So trying to take the speculation out of that market. Now, these are in addition to changes of the recent macroprudential rules in placing limits on lending to certain loan-to-value ratios. So trying to keep the market available and affordable to owner-occupiers in the New Zealand market. It has obviously different elements to it. It's set up structurally different. You traditionally have never paid capital gains tax on investment properties over there. So they are structurally trying to adjust their markets different to Australia. So we don't expect that policy to arriving here anytime soon. Speaking of Australia, let's talk about what the RBA did today. They remained on message in terms of their signalling to the market around their key three themes. And that is rates on hold until at least 2024 at the earliest. They want to keep buying bonds, and this will obviously keep fixed and lending rates lower and also help with keeping the Australian dollar lower for exports. And then the third area of policy, which is not directly relating to them, but it's also relating more to the property market, was lending. They wanted to keep a close eye on lending standards to make sure that they weren't creating any risk in terms of systemic risks in the property and the overall economic markets around property prices moving too high. So this means that the RBA kept the cash rate at 0.1%. And again, no rush in moving that anytime soon until inflation is substantially within the 2 to 3 per annum range is their focus. And this is not likely to occur until till substantial wage growth where they see that above 3%. And then we'll start to see inflation creeping into the economy. That's why they still believe it's 2024 before they will move the cash rate. In other RBA news, they are delaying the decision to expand the yield curve controls. And what this basically is meaning is just that they're not going to do anything in terms of they're going to watch the market, watch the economy for a while before they make any decisions around their bond buying program. At this stage, they'll continue to keep buying bonds to keep that yield curve also in check. In terms of GDP numbers for Australia, we did see GDP numbers released for the December quarter. We saw a 3.1% increase in GDP over that period, and that beat consensus expectations. And that also meant that overall over 2020, we only saw our economy GDP decline by 1.1%. Now, in global terms, the Australian economy has continued to demonstrate its resilience. It was indeed among the major economies in the world that outperformed. And let's put that into context. Australia's performance was a standout. Only China and Taiwan can claim a better performance in 2020. So hands off, well done to all of the governments and the regulators for getting us through this period so well. Household consumption rose 4.3% in the quarter as the economy continued to reopen and consumer confidence improve. The strong result follows a record 7.9% increase in the September quarter. Households have been dipping into their large saving buffers that they accumulated over the year, which is helping boost spending. Household saving ratio declined to 12%, which is down from 18.7% in the previous quarter. And those government handouts are also drying up, which means that obviously some of that spending or savings buffers will now be spent in the economy. In other important and positive GDP news, business investment came back to the table by the tax incentives. We saw a lifting of 2.6% in the quarter after decline for the previous 6 months. So that is also positive news as we see businesses start to invest. Unemployment, let's look at the big picture here for unemployment because I think there's a good story to tell here. Job vacancies grew 13.7% in the 3 months to February and are now well above COVID-19 levels. According to the ABS, there were 288,700 job vacancies since November, 260,300 in the private sector, which is an increase of 14%, and 28,400 in the public sector, which is an increase of 11.1%. For context, private job vacancies are now 29% above their pre-pandemic levels of February 2020, while public sector vacancies are 13% higher as well. And according to the ABS and the ATO, from the 14th of March 2020, where the pandemic began in Australia, to the 27th of February 2021, payroll jobs are down just 0.2%, while total wages paid have increased by 1%. At their lowest ebb in April 2020 last year, payroll jobs were down 8.5% from their 14 March 2020 levels. In addition to that, JobKeeper definitely ended at the end of March. So now we're in a situation where we might see a short-term spike in job losses, and that'll be the result of those businesses who have been receiving JobKeeper, who will have to now lay off some of their employees. So there is an expectation over the next couple of months that the unemployment rate might go up a little bit higher, may spike over the short term, but the economists believe that they will resume to decline, I should say, by the second half of 2021. So we did see the unemployment rate data. So this jobs grew by 88,700 in February, the best result in 4 months. And the economy has recovered, as I said, that 99.8% of the jobs lost in February and to May last year. The unemployment rate fell to 5.8% in February, and this is the lowest job reading on unemployment since March of last year, before we went into lockdown. Consumer confidence, more good news here. The Westpac Melbourne Institute Index of Consumer Sentiment rose 2.6% to a reading of 111.8 in March. This follows business confidence hitting its highest level in 11 years. Confidence has been buoyed by improving economic conditions and commencements of the vaccine rollout. The increase in sentiment was broad-based across all sub-indices, which was led by an increase in the economic conditions over the last 12 months, which rose 3.7% to a reading of 113.8, and now sits, get this, 46.1% above a reading of a year ago. The uptick in sentiment is consistent across all states except Victoria, which eased 3.4% following a strong reading in February, as it obviously bounced back after its large lockdown at the end of last year. The sustained high level of consumer confidence is an encouraging sign for the next leg of the economic recovery. Optimism is help fueled spending, which in turn generates more economic activity. This will be supported by progress in the vaccine rollout and further improvement in economic conditions, with record low interest rates to continue. So positive news story there. Retail spending, we did see a drop in retail spending of 1.1% in February. And this is the result of January also being revised down in growth of 0.5 down to 0.3 of 1%. Many lockdowns in individual states on the back of COVID outbreaks are likely to have contributed to the weaker result. However, underlying momentum in retailing remains solid. Furthermore, the recent job gains, upturns in house prices, new building and construction permits being released, and elevated household saving ratios suggest that retailers will continue to grow at a good rate in the coming months and possibly years. And for context, retail sales are up 10.6% in the year-ending terms compared to the long-term average pace of 3.8%. So that gives you an idea that the economy and spending is up and about. In terms of business investment, the Australian Bureau of Statistics in mid-March ran a survey of business conditions and sentiments. This has been a continuation of the survey that they've been running through the COVID period. And here are a couple of the key takeaways. The survey showed that business outlooks continues to improve. Businesses report improved financial circumstances and less reliance on government support measures. The share of firms finding it easy to very easy to meet their financial commitments rose from 23% in August to 46% in March. Similarly, proportion of firms finding it difficult or very difficult to meet their financial commitments has fallen from 35% in August last year to only 17% in 2021. The survey also includes insights on employment. Nearly 9 in 10 employing businesses reported that they have sufficient number of employees. So obviously they're not looking to lay off. And on the other side of it, 1 in 5 businesses plan to increase staff numbers over the next 3 months. So that's a good sign for employment conditions. Business confidence. We did see businesses are definitely more upbeat in February. The business confidence index rose to 16 from a reading of 12 in January, reaching its highest level since early 2010. And this is well above the long-term average. So confidence is also reappearing in the business area. So business conditions also improved in the month, rising to 15, returning to close to its December level of 16, which was the highest reading since 2018. All subcomponents of the business condition index rose, notably employment index increased from 3 to 8, suggesting again that job growth remains above average. So we look forward to seeing those. Continuing on our business theme, the Westpac Australian Chamber Index of Business Activity increased to 60.4 in the March quarter after rising to 48.8 in December quarter and 43.4 in the September quarter. The recovery follows dramatic falls to 24 in the June quarter associated with the initial lockdown and the response to COVID-19. A reading above 50 suggests an expansion. The survey reports an output started the year ago on a strong note, and new orders have increased for the first time since Q4 of 2019. So that says to us that the manufacturing movement is also going well. Let's look at exports. Well, we did see exports surge in the first 2 months of 2021, beating expectations. Exports rose by 60.6%, well above consensus estimates of a 40% increase. The increase reflects a low base, obviously, in 2020 when we shut everything down, and strong global demand for manufactured goods, which means our raw materials are in strong demand. Our trade surplus hit 10.1 billion in January, a fresh record high, well above market expectations again of 7.5 billion. The January result was an improvement of 3 billion on December. The widening in the surplus was made possible by growth of 6.2% in export earnings and a fall of 2.3% in imports. Australia's trade accounts has now been in surplus for 37 consecutive months, each month through 2018, 2019 and 2020, and now also into the opening of 2021. Private credit. So let's look at people getting access to credit. In terms of private credit, grew by 0.2% in February. This was in line with the growth of January and also gives an annual growth rate of 1.6%. Credit is expanding at a slow pace, which is not a bad thing if we're talking about personal credit. Business credit growth rate is 0 for February and follows 9 consecutive months of declines. So hopefully this is the turnaround signal, and next month we move into a positive reading. But over the year, business credit has declined by 0.2, and this has been the lowest annual growth since August of 2011. So let's again hope that we see that number turn positive in next month's data. In terms of housing, credit has picked up since late 2020. Credit for housing grew by 0.4% in February, the same pace as in January and December. This brought the annual rate of growth on housing credit to 3.8%, and this is the strongest since April 2019. Other personal credit growth continues to decline, to fall of 0.5 in February. Households are prioritising paying down debt, which isn't a bad thing for some of those households. Now let's turn our attention to the very hot property market. Let's start with the housing lending and taking a little bit more of a deeper dive here. New lending for housing rose to an eighth consecutive months in January, increasing a further 10.5%. Low interest rates, government assistance programs, and expectations of further price growth has put a rocket under demand. Yes, it has. New lending was up 44.4% in January last year, the highest growth rate since the series began in 2002. And this is a boom with monthly new lending at record levels, no doubt about it. There was strong demand for both owner-occupier and investor. In new lending, owner-occupier rose 10.9% for the month and is up 52.3% on January 2020. And new lending in investment was up 9.4% off a lower base. The proportion of first home buyers, which is good news for this market segment, are among the owner-occupiers obtaining loans continues to rise. In January, they accounted for 36.5% of new home loans in this category. So good on you, firsties, for getting into the market. In terms of building approvals, we did see building approvals bounce up 22% in February following a 19.4% decline in January. And this marks the highest monthly growth in approvals since 2013. However, it's fair to say that the whole application process on the home builder grants has driven volatility month by month in this particular space. So we just think that that's the government catching up with the paperwork. Overall, approvals are now 20.2% up over the year, well above their pre-COVID levels. And you got to think this is a remarkable strength in private sector housing approvals, which has increased 15% in February to reach a record high. Over the year, private sector housing approvals are up an extraordinary 57.1%. The increase in residential approvals in the month was broad-based across all states, with the highest growth in Queensland at 34.5% and Tasmania 31.6%. Over the year, however, WA is the clear standout, where approvals are up 148.7% in the West Coast for the past 12 months, which is well above all other states. In terms of the property prices, well, we did see CoreLogic last week release their March result, and we saw a rapid increase of 2.8% in property prices in March. And this is the fastest pace of growth in 32 years. And it also took the index to a highest overall record. Price gains were broad-based across Australia, but were led by our big capital cities for the first time in a year. Prices in the capital cities outpaced their regional partners. In terms of Victoria, also staged a complete recovery from lagging the rest of the country and had the price for the fastest pace of dwelling prices in March went to Sydney, however, where dwelling prices were 3.7% higher, the quickest clip since August of 1988. Double-digit price growth gains were recorded in Hobart, Darwin, Canberra, and regional Australia over the annualised period. So let's take a closer look at those numbers. We'll take a deeper dive. We did see Sydney 3.7% for the month. In terms of for the quarter, 6.7%. Melbourne for the month, 2.4%. For the quarter, 4.9%. Brisbane, 2.4% for the month, 4.8% for the quarter. Adelaide, 1.5% for the month, 3.2% for the quarter. Perth, 1.8% for the month, 5% for the quarter. Hobart, 3.3% for the month, 7.6% for the quarter. Darwin, 2.3% for the month, 5.4% for the quarter. And Canberra, 2.8% for the month and 6% for the quarter, giving us combined capitals 2.8% for the month and 5.6% for the quarter. Combined regionals, 2.5% for the month and combined for the quarter of 6.3%. So there's definitely plenty going on in the property space. Which brings me back to my question. Are we back in the roaring 20s? Are we there again? Now, for those of you who aren't familiar with the story or are a little bit young, at the end of World War I, and we also saw this, which also had a pandemic involved between, say, 1918 and 1920, where we did see the Spanish flu account for almost 3% of deaths in the world's population. Well, post the war and the pandemic, what followed was a period of prosperity. So it was a decade of prosperity where Western society and culture, on the back of strong economic growth and prosperity and wealth prosperity, did see a significant change there. Now, the question then is, are we well placed where we will see the roaring 20s for ourselves this time around? Well, the data post the COVID pandemic, and we are still in the pandemic, there's still a way to go, but by the end of 2021, we should be seeing some real strong momentum when it comes to the Australian economy. Now that, in addition to also potentially opening our borders to see more immigration arrive and more upside in terms of population growth, also gives us even more favorable conditions for stronger economic growth as it stands today. So there is a story there, and it is probably, we're starting to see some of the data start to show up here. So let me see, are we starting on our roaring 20s already? Because we did see from the ABS, they released their household wealth data, and that showed some interesting results. So let's go through them. The household wealth increased by 4.3% in the December quarter, the highest quarterly growth rate since December of 2009. Total household wealth and wealth per capita were at record levels of $12 trillion. And that's $467,700 per person, right? So that's just giving us some idea. And that's, that's before, that's the December quarter. So now we're obviously seeing the March quarter where we're seeing some of this economic data, property prices moving higher. So that's also giving us that story. Now, we understand that the growth was underpinned by increases in house prices. Through the year, household wealth or household property wealth increased by 7%. Residential assets rose 7.7, sorry. So that household wealth increase was 7% over the year, and property prices contributed 6.1% of that growth. So that is the question. Are we seeing signs of another period of the roaring 20s? Now, Bryce and I have been talking about this on the Property Couch podcast, where we do believe, the demographers are also telling us that Australia is incredibly well placed in terms of having a very prosperous decade throughout the 2020s. So we'll see whether time will be the judge on that, and whether this will also be known as another period of the roaring 20s. So until next month, just remember, knowledge is empowering, but only if you act on it. And if you are looking to get into the property market, there is still opportunities out there for you, but you need to be prepared. So go and get some advice, line your eggs up and your ducks up in a row, and make sure you do all your homework before you go out and buy, because it's tough out there. And, best of luck in your endeavors to get out into the property market. Until next month, bye for now.